Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we enter another week on the back of what is now close to 6 weeks of pretty optimistic markets. S&P 500 up over 25% since the April lows. We've erased all of the losses from 2025 on the S&P 500, and we seem to be within just spitting distance of the all-time highs. Last week, unemployment came out slightly better than expected, adding 139,000 jobs in May of 2025, with the unemployment rate continuing to stay steady at 4.2%, which really just continues to confirm that some of the concerns that investors have had, earlier on this year with regards to the overall slowdown of the U.S. economy, so far has been largely unfounded, meaning the hard economic data coming out so far has not shown any type of drastic slowdown. It's been certainly a deceleration in terms of growth, but we certainly haven't seen a reversal here in terms of the strength of the U.S. economy. We've seen business sentiment tick up a little bit here. So overall, the economic picture has been quite strong. That has supported, the strength of the equity markets that we've seen here over the last few weeks. Now, at the moment, I think probably the biggest things for investors to really pay attention to here right now are the trade negotiations that largely have remained unresolved. You have US and China going to the negotiation tables this week. You have a 90-day pause in the tariffs that are coming up in less than a month at the beginning of July. So there are major trade negotiations that still have to be done before then at the moment. And at the same time, you have the VIX that has pulled back here below 17%, despite what I consider significant headline risk and the large looming budget deficits. So, the fact that the VIX has pulled back to below 17%, I think represents, it reflects two things. It reflects the optimism that the market currently sees with the reversal from the April 2nd lows, to the kind of optimism that we started to see here with regards to AI as a theme continuing to drive growth here again, with the strong earnings out of NVIDIA a couple of weeks ago, kind of reigniting interest in that particular industry. But at the same time, with VIX below 17%, from my perspective, that represents a bit of complacency for what is still significant amount of headline risk with regards to trade negotiations. And probably more importantly for me are rising bond yields. We saw 10-year yields last Friday rise back above 4.5%. We've seen the 20 and 30-year yields approach 5% here again. We did see some of that pull back here yesterday and going into today's open. We have the 10-year yield back below 4.4% here. You have the 20-year back below 5% here, even though we opened up above 5% on Monday. So there are some signs that the Treasury market are moderating, but we have to keep in mind that 10, 20, and 30-year yields are basically within spitting distance of all-time highs. That doesn't quite add up with equities near all-time highs either. So the kind of the inverse correlation that we see between yields and equities is not currently holding up, and I think that's really something that we need to be paying attention to right now. Probably on the calendar, the most important thing are the longer dated bond auctions on June 12th, which is on Thursday of this week. You have 30-year bonds. The auction for the next 30-year bonds is on June 12th. The following after that is on June 16th, which is the following Monday. So those are the two big events that have driven some volatility in the short run, and I think is important um, for investors to pay attention to because at the moment with the VIX below 17%, I think there is a underpricing of the risk that treasuries present here for the equity markets. Um, the the last treasury auction that ended up going fairly poorly was one of the drivers of volatility here, and I see that that is a potential for volatility here later this week here as well. So that I think is probably the most important thing to be paying attention to here this week. We're fairly light on the economic calendar, we're fairly light on the earnings calendar. As we're looking at kind of going forward, trade negotiations and bond auctions, I think are going to be the biggest things that you need to be paying attention to here for this week. You had Apple's developer conference that came out here yesterday that was largely underwhelming. Um, so this is really something that I think is also weighing on some of the growth names like Apple here in the short run. The S&P 500, as it approaches kind of these all-time highs, continues to be at at a level that I think is concerning for a potential pullback here. So let's take a look at the S&P 500. Basically, what we saw here is basically a continuation higher towards recent highs, right? So the all-time highs are up here around 610. As we kind of reach around $600 level here, one of the things that I've noticed is that you start to see some exhaustion here on the um, on the breakout higher here. So as we kind of consolidated here over the last couple of weeks after the breakout here, and we start to push higher here, higher highs are no longer being met by higher highs in momentum. So there are clear signs of exhaustion here from buyers here. And this really leads to a higher probability of a pullback here. And there's not a lot of support here. You have some support here, probably around 570, but the next level of support here is closer around 530 here to the downside. You have a gap here just shy, just a little under 530. So you have a significant amount of downside, in my opinion, versus the potential upside here is fairly limited. So the risk to reward ratio in terms of equities right now certainly skews more here to the downside. You see it on the S&P 500. You also see it on the NASDAQ 100, higher highs in price, no longer being confirmed by higher highs in terms of momentum. You see it on IWM. IWM recently did manage to get back above this 210 level that has been a major resistance level for quite some time, but that breakout here above 210 also not being confirmed by momentum. So clear signs of exhaustion on S&P, NASDAQ, and small caps of the Russell 2000. And then when you look at RSP, equal weight S&P 500 index, note how we're nowhere close to the all-time highs, or we haven't even made new relative highs recently. So, what this is showing us is that even though the S&P 500 is making what seems like absolute highs, there isn't a lot of participation on that. So it's really kind of some of the mega names dragging the markets higher, which isn't particularly healthy. So we have a lot of uh, the hallmarks of a equity rally that is losing steam, where buyers are starting to get exhausted, and a higher probability of a short-term pullback in the short run. So, if you're a swing trader, this might be an opportunity to start looking at taking some profits on the long positions that you've established over the last 5-6 weeks, or perhaps starting to look at selling some premium to the upside, whether that's through covered calls or credit spreads, and potentially even using some of that premium to look at seeing some downside protection or seeking some tactical bearish opportunities here in the overall market. And like I said, in the bond market, what's interesting is that if you look at the corporate bond market, even in the high yield corporate bond market, we continue to make new higher highs. We actually made a new 52-week high in HYG, which is the high yield junk bond ETF. We did not make a new 52-week high. We made a new relative high. But what we're seeing here is that the bond market continues to show a fairly risk-on signal here, while the corporate bond market continues to see a relatively risk on signal here versus the treasury market is showing us a completely different picture, right? Look at the treasury market has sold off pretty heavily here over the past year or so. And we're basically trading just around 52-week lows. Now, yes, there are some, opportunities potentially be a buyer down here if you feel that the treasury market is sort of overblown. But from my perspective, I think that the risks, um, you know, in the treasury market are nowhere near being solved, and there remain some downside risks of treasuries kind of breaking back down to new 52-week lows and yields continuing to rise. So those are the kind of the risks that I currently see here with the broader markets at the moment. So with that in mind, let's take a look at some of the opportunities that we currently see here in the markets. From my perspective, looking at opportunities really has to be focused more so on sort of, in the bullish realm, they have to be sort of your high conviction trades. And then starting to look at explore some bearish opportunities. So the first one to take a look at here is Adobe. Adobe reports earnings here this week. Adobe recently broke out here above this $400 level. This is kind of the level that we've been paying attention to here for quite some time. This $400 level has been a major support and resistance level basically since the beginning of the year. And recently we broke out above that level here, retested it as support, and now we're looking for this to continue higher here. Adobe trades at what I would consider a very reasonable valuation, around 20 times forward earnings, even though net margins are north of 30%. So, a lot of concerns that Adobe was going to be disrupted by AI. But very clearly, Adobe has actually embraced AI and is now a leader in this particular has become a leader in AI, and has become a software company, in my opinion, that is investable within the AI theme at what is considered a very reasonable valuation, given how fast they're expected to grow, and more importantly, how profitable they are. Not a lot of companies with net margins north of 30% are only trading at 20 times forward earnings, especially software companies that typically can trade at much higher multiples because their businesses are highly scalable. So for those reasons, I think Adobe trading, coming up with earnings this week, trading a shorter dated, let's say a weekly June debit spread. So for example, if you're buying, let's say a 415, 440 or 415, 450 type debit spread makes a lot of sense, where you can get about a 2-to-1 risk to reward ratio on a short dated move. This is 10 days from expiration. The earnings are in 2 days. This is the type of trade setup that you can look at for trading Adobe. The next one I want to take a look at here is Charles Schwab. Charles Schwab trading at about 20 times forward earnings, also quite attractive from a valuation perspective, recently reaching new 52-week highs, breaking out to new 52-week highs on both a absolute and relative basis, relative strength of 8 out of 10. And this is really one where you can look at either selling premium, either looking at selling a cash secured put or a credit spread, or even looking at just outright buying the call or call spread using the options play platform. Schwab also trading at 20 times forward earnings with net margins north of 31%. The other one I want to take a look at here is Micron. Micron is in the semiconductor space, but more specifically in dealing in memory chips in the semiconductor space. And Micron, as you can see, if we look at a chart here, this is a stock that has largely been range bound for quite some time. It's actually now trading back towards the upper bound of that range. But this is a stock that is, potentially, in my opinion, poised to break out here from that range and break out significantly higher from here. Because if you look at this particular stock, it's trading at about 8 times, it's trading about 10 times forward earnings. And the reason that I like it is really because a lot of investors interested in AI, the most obvious type investments are stocks like NVIDIA. But NVIDIA, even though a couple of months ago, I would argue was one of the most undervalued investments in the market, has certainly rallied quite a bit here over the last few weeks, and is trading now north of 30 times forward earnings here again. Even though net margins of 55% plus with growth rates that are, exceeding 30-40% per year on both top and bottom line, I think more than justify the valuation around 32-33 times forward earnings. But, it's not cheap. Versus Micron, which builds the memory chips that go into the NVIDIA GPU graphics cards, it's trading at 10 times forward earnings. Now, memory type companies generally trade at lower valuations, but if you look at kind of net margins north of 15%, growth rates that are still, is just as attractive as kind of some of the NVIDIA growth rates, I think Micron is an interesting alternative, or for those that are looking to diversify some of their AI investments away from just being concentrated in NVIDIA. Micron Technologies is one worth paying attention to. Now, this is really one also reporting earnings in 15 days at the end of June 25th. You can play this a few different ways. You can look at selling a credit spread potentially, or, similarly buying a debit spread to trade that earnings event with limited risk. So Micron, one of the ones that I like here at the moment. Looking at the opportunities here for the, just lost my, here we go. Now looking at kind of some bearish opportunities. So at the moment, I think that looking at the bullish opportunities, you really have to stick with really high conviction ideas in a market where the S&P is already fairly overbought or overextended by pretty much most measures, especially, when you see a 25% plus rally in about a month. I don't think now is the best time to be pushing new long positions unless you have a very high conviction or a catalyst, like earnings coming up that could drive the stock substantially higher here. Otherwise, I do think that it is worth tactically looking at some bearish opportunities here in the market. So the first one I want to point out here is Walmart. If you look at Walmart, we have seen the stock basically has kind of stalled here around this $100 level here. This has been a major resistance level multiple times, and recent kind of attempts to break out here has failed. And my view is that this could pull back here, not a deep pullback here, but a shallow pullback here down into the $90 range. Walmart trades at 37 times forward earnings, which is more than double the industry average. Yet it's not expected to grow any faster, and it's not any profitable than its industry. So, if you're not growing any faster and you're not any profitable, trading at double the valuation has quite a few risks in terms of down to the downside. It's trading at double the valuation from an earnings perspective. It's trading at double the valuation from a revenue perspective. So all around, Walmart is just expensive. Now, yes, a lot of people are looking at kind of their e-commerce business, which is just turned profitable, and kind of looking at kind of their pivot towards kind of an Amazon style business. But net margins of 2%, meaning their margins are razor thin. It really leaves a lot to be. It leaves a lot of risk on the table when you're trading at such rich valuations and you're playing with such thin margins in an environment that is incredibly uncertain with regards to trade policy, and where Walmart sources the vast majority of their goods from China. That's a huge risk here for that overall business. So I think for it to be trading at such rich valuations, leaves some room for some downside opportunities for a name like Walmart. The next one I want to take a look at here is Apple. I just talked about Apple's developer conference. which was yesterday, largely I would say is fairly underwhelming. They didn't show anything with regards to AI. They had some updates on iPad that was interesting, but largely, it was an event that wasn't particularly exciting, at least compared to if you look at the developer conferences of Alphabet and kind of what they're doing with an AI perspective, or Samsung. Apple is really kind of lagging further and further behind on that front, and that's why the stock was down, a little over 1% here yesterday when the markets were, a little bit higher. The stock is down 20% here for the year, while the S&P 500 is up on the year. So, this is a company that clearly is starting to lose quite a bit of its dominance here, and I just can't help but think that there's further of that ahead. So I think this is one where looking at selling call spreads makes some sense. Apple trades at 26 times forward earnings, which has come down quite a bit here over the last few months. When I started taking bearish positions here in Apple, is trading at 28, 29 times forward earnings. So trading at 26 times is a little bit more reasonable, but at the same time, over the last few months, growth expectations has also continued to decline. When we started this, I would say about 6 to 9 months ago, Apple's expected to grow top line by about 12, 13%. That's now reduced down about 8%. They were expected to grow revenues by about 7, 8% at the time. That's down to 5%. The only thing Apple's been able to maintain are its net margins, which remain somewhere around the 24, 25% range. But I think we're starting to enter a phase where Apple's net margins are also potentially going to start looking at getting some squeeze to the downside, some downside pressure on net margins. And I think that's really where, the valuations, the premium valuation that Apple trades at is going to start coming into more of a concern for investors. So again, the charts tell a very clear story. The fundamentals, in my opinion, also tell a pretty clear story, and that's why I continue to take a bearish view here on Apple. And then I'll leave you with one more bearish trade idea here for the week, which is T-Mobile. T-Mobile, similar to some of the other companies that we brought up here, trades at a valuation that's nearly double what the other stocks trade at in its industry. Notice how it's down 3.25% here. Yesterday alone, the stock has clearly been on a recent downtrend, and looks like that downtrend is potentially starting to accelerate here to the downside. So this is the type of trade where I would be looking at maybe buying a put spread here. Trades at 23 times forward earnings, which is more than double the industry average. It does grow faster than the industry, grows faster than AT&T, grows faster than Verizon. Net margins are just a hair higher than the industry, not much higher at 14% versus 13%. So slightly more profitable, but I think that the growth that T-Mobile has had over the last few years is clearly starting to decelerate, and that's why we're starting to see some downside risk with the valuation that's, again, more than double what the industry average is. So looking at T-Mobile, I think this is an opportunity where looking at buying some put spreads might make some sense. So with that covers what I wanted to share with you here today. Hopefully this gives you a better understanding of how we're viewing the broader markets in terms of, important levels on the S&P 500, what we're focusing on right now with regards to the trade wars and the upcoming bond auctions. The next big one is on Thursday, and then giving you some trade ideas here for the week. With that, thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week.